Net Wealth Investments Limited is licensed to provide general advice. Our podcasts are not tailored to any one financial situation and may contain views of our presenters which may not align with Net Wealth's. The guests' organisation and Net Wealth have an arrangement for their financial products to be available for investment through the Net Wealth platforms, and Net Wealth may receive fees from the guest. More information about Net Wealth can be found on our website, including our financial services guide and disclosure documents. Please seek professional advice before acting.
That's my basic mantra. Investing generally is not complicated.
They wanted to support us, but they also wanted to see us succeed before they really gave us that support.
So we have a very, very strong footprint around about the 12% mark of the professional advisors in the industry today.
I think we can probably do a little bit of work as advisors and advice firms to just sort of simplify things and take a step back, unpack it all.
Hi, and welcome to Between Meetings with Matt Heine. In this podcast series, NetWealth's CEO and Managing Director chats to industry leaders and innovators with local and global expertise. They discuss the latest technologies, business models, and demographic changes, as well as leadership lessons and trends that are impacting financial services. We hope you enjoy their unique insights.
Hi, welcome to this episode of Between Meetings. I'm excited today to be joined by Michael Goodman, who's kindly joining us from New York City. It's 9 a.m. in Melbourne and 7 p.m. in New York. So thanks, Michael, for joining us so late in the evening.
Yeah, it's my pleasure. It's a pleasure to be here. Thanks so much for having me.
Now, for those that were lucky enough to be on the NetWealth study tour this year in New York, Michael was the standout session from what I hear. I wasn't there, so looking forward to a really engaging conversation. But some of the feedback that I've had is, A, you have to speak to Michael. He's built an incredible firm. He's growing really well. But more importantly, he's won Best Place to Work 3 times and built an incredible culture. So we've got plenty to chat about. But Michael, it would be great if you could just start off and just give us a bit of an overview of your firm and what you're doing.
Yep. Thank you very much. Sure. Happy to do so. So we are what we would call a wealth management practice, which to me means 2 things. It covers both full comprehensive financial planning as well as investment advisory. The firm is based in New York City, as you mentioned. Our office is in Manhattan. And the firm is about 29 years old when I kind of started the business from scratch. Today, we have 23 people, including me, on the team. And we manage about $1.7 billion of AUM. We provide, like I say, a comprehensive service where we work with about 420 families or so. So we really focus on trying to have deep, full client relationships as opposed to sort of a volume type practice.
So looking at your website last night, and particularly the clients that you service, it seems to be quite spread across sort of different, I guess, client types. Is there something that binds them together or that you sort of see as your niche?
Yeah, it's an interesting concept to talk about. But I would say the big thing that binds them together is we work with clients that are interested in building full relationships, taking advice, really talking about what's important to them. We don't work well with transactional type clients or clients that are just focused on rate of return. We really work best with clients that want to engage deeply in what's important to them, their families, their goals, etc. And I know that sounds a little trite, and that's what everybody would probably hope for. The reality is, when I started the practice, I didn't know what a niche was. Now that we've built out the practice, there's a couple of niches within the practice, but and I know there's a lot of advantages to having a niched practice, but I was a generalist at the start and just kind of accumulated a lot of clients across the board, as you say.
To manage 1.7 billion with 22 staff is no mean feat. So I'm assuming that you are incredibly efficient, and just be interested in sort of how the business has grown over time and what are some of the things that you've done to actually allow you to scale to that point?
I would say that a lot of my weaknesses are a lot of my advantages, if you will, or strengths. So interestingly enough, my background as a public accountant, as a CPA, or I think you guys call them chartered accountants over there. And being somebody who is sort of very type A, likes to have a checklist and a process, that has really paid off. In the beginning, it slowed me down because I always had to have a process, and building out those processes took quite a while. But once you get that in place, you realize that there's a lot of strengths to that. And we use workflows obsessively in our business through our CRM for everything, and everything seems to run on a track, and that obviously helps things don't fall through the cracks. Clients are never hopefully surprised by anything. Everything's a process. And that has really allowed us to do that. Also, I would say technology. Now, when I say technology, I'm not talking about cutting edge today, but I think we were cutting edge 15 years ago when we adopted a lot of technology and we went paperless early and we used a really good CRM early and things like that, where a lot of firms were kind of probably working with less technology. Today, I would say we're an average firm technology-wise, but building that platform has helped.
It's a really interesting point. And when I look at the size of the business, you've got 400 family groups. How many advisors or principal advisors have you got servicing them?
Yeah, there's 8 advisors that are really the primary relationship and contact for those families. So we also, as you could do the math, have a fairly low client to advisor relationship. By having a higher minimum and a higher average client size, we're able to do that efficiently, economically efficiently, I should say.
And is that something that you think provides a lot of upside potential, or do you feel that that's about right and now it's around bringing in and sort of expanding the number of advisors that you work with?
And we definitely feel that we have capacity in on our advisor base. We feel that not every advisor, but on average, and each advisor could still take on some more capacity. I've always tried to run the business with a capacity mentality. I learn all these things I share with you that I do are all from learning from mistakes. It's not like I've come with some crazy knowledge out of the womb, if you will, or in school. These are all lessons learned. So I found that when you don't have capacity and you have to hire quickly, you tend to make bad hiring decisions and you want to bring people along at the right pace. So I've always had the attitude of, let's have a slightly lower P&L perhaps, but let's make sure we keep the right people, we train the right people the right way, and we create that capacity. So when something does come about, we're prepared for that.
That's probably a really good segue, and I know something you're keen to talk about. The feedback has been, I think, that you have an outstanding culture, and that really is one of the things that differentiates you from many other firms. 22 staff, love to hear how you've grown that team, what sort of retention mechanisms, how you actually find that next generation of advisor as well.
Yeah. So once again, I'm happy to share and I'll tell you everything about it, but I don't think it's anything magical. I think that what happened is when I hit 100 million in AUM, I said, okay, I took a deep breath because I started at zero and I started the business on my own. I didn't work for another firm per se. So I got to that point. I said, okay, I'm going to make it now. I'm going to be able to pay my bills. I'll make a decent living. Hopefully I'll, be able to retire one day. And what got me to this point is not going to get me where I want to go, or at least the next 100 million at least. So I hired a consultant and we sat down for the day. And one of the big things that came out of that was, what do you want your firm to look like? What are the clients you want to have, et cetera? And every time we went through this list and kind of culled it in different ways, coming to the top of the list was, I want the environment that I work in to be a good environment, a positive environment. I love to say fun, but work's not always fun. So I don't want to patronize everybody, but I wanted it to be an environment that people wanted to work in. And I've always thought about it that way. That's probably the result, once again, of, some bad experiences as an employee in some other places and not feeling like I was respected or treated well or compensated well. So I always try to give everybody the benefit of the doubt. I remember hearing, I don't remember where or who said this, but, a lot of bosses, but by the way, boss spelled backwards is double S-O-B. So, that's something to consider right there. But a lot of bosses, when employees come in, they close the door and they, shut the door and, they don't lock it, but they shut the door, right? And they keep them inside and they want them to work as much as they can. Somebody once said to me early on you want to swing the door open. You want people to be able to be free, expand, go out, learn, develop their careers, get credentials, do these kinds of things and support them in their career. Hopefully that support leads them to better places down the line in your own organization. But you know what? If it brings them to something that you can't solve in your company, well, then that's okay. Wish them well. They'll do great. It's okay. It's fine. And I've always had that attitude about treating people that way and trying to make work, as great of a place it could be to work. And it's like, I didn't do it because I thought it would make me successful. I did it because I wanted to be happy myself. And it's turned out to, be a great result, not only for the obvious reasons, but it's also been great for economic reasons.
I was going to say, so obviously treating people with respect, some of those foundational things that you just have to do. Are you able to also drive high performance through the team? And what are some of the mechanisms or ways in which you not only create a sense of fun and engagement, but also high performance?
Yeah, good question. One of the delicate things that we've had to sort of kind of communicate when we're hiring so people know and expect that that's going to be the case is that, there's this concept of work-life balance. And I don't really love that term because you're either working or you're not working. So the idea here was that we were going to give people a lot of freedom, whether it's time off or flexibility to go out and learn like we talked about. But when you're working, there's rigor. So we talk about that. We don't want you to work late at night. We don't want you to have to come in early. We don't want you to have to work weekends. But while you're working, there's rigor. And we recruit with that mentality. We also recruit people that have a work ethic that we feel is going to match up with what we're trying to achieve. So that's something we consider through the recruiting process tremendously.
And the recruitment process, it's not always easy to get it right. You meet someone once or twice. Can you test for that rigor? What are some of the practices or processes that you've put in place to, increase success?
Yeah, we've actually been told that our recruiting process is a turnoff to some people. We've been told that it's too rigorous, but we haven't changed it a bit. We, especially on the advisor side, or now even on the client service and operations side, we've implemented some of these elements. There are probably several interviews that people go through. We do full set of assessments. We do a full case study that a candidate must go through. We give them a full fact pattern, have them put together a presentation and present that to 5 or 7 of the advisors. We also have a robust internship program. So we try to get a lot of our candidates that have interned with us, and that's a really great way to spend some time with them. But we are kind of very picky around that. And also we do that as a community. So it's not just 1 or 2 people that kind of manage our recruiting that do all the interviewing. Of course, we have 1 or 2 people that kind of set it all up, but there are probably a minimum of 5 to 7 people that interview every candidate.
Fantastic. So it's a huge investment in time, but a big payoff at the end.
Yes, it has been. It definitely has been that.
And when you say you've been told it's too rigorous, do you see that through the candidate experience where people drop out along the way, or where does that manifest?
Yeah, in both. Yes. So we have seen some candidates just be like, I'm good, thanks. And then we've also been told by so we recruit out of some of the schools here in the States that have really good financial planning programs. But on the client service or operations side, a couple of times we've used recruiters to help us with that. And the recruiters have been pretty vocal about that. And the professors that we've spoken to at some of the schools have said that the students have commented about the program. The professors have actually complimented it, saying that they think it's a good thing because the students really see that we are very serious about who we bring on and that we don't take it lightly, and that there's a positive angle to that as well.
Fantastic. So when you think about where you've had your best success, either recruiting in or through that intern program, is your preference to effectively build and train someone from scratch, or do you also try and buy in expertise at different levels?
Yeah. So on the advisory side, for people that we're basically trying to bring up through the advisory career path, it was a shift about 10 years ago. Historically, I was rather negative about hiring students right out of college because I felt probably like myself, I didn't really know what I wanted to do out of college. And I was a little skeptical of making this big investment in them. And there's this terrible reputation that this generation has about not staying, which is, I don't think is true, but not staying the course and kind of jumping around. And I fell for that. But about 10 years ago, I made this shift. We recruited somebody out of a school here called Virginia Institute of Technology, and they have one of the top financial planning programs. And it's been an amazing success. That person is now a lead advisor. She's in the leadership team of the firm. She's a shareholder, and she's wonderful. And that opened my eyes to how it works. So we actually only want to recruit people out of school now because we feel that we can train them, mold them, and get them where we want to go. And we've built a really good process to make that happen. It's a little bit harder on the client service or operations side of the business. And sometimes in that instance, it is better to have some people with some experience because there is a bit more of a sort of industry learning curve, if you will. But we're working on that side now. We just started an internship program for the client service operations side of the business.
You've mentioned a few times the quality of the financial planning in the schools and universities. One of the challenges may have been raised with you when you caught up with our team is that we don't have enough financial planners coming into the industry. In fact, our numbers are going backwards. How is financial planning seen as a career in the US? And are you hiring in for technical skills and then teaching them the soft skills, or are you finding that the universities are doing a good job across both sides?
Yeah, so here we have the same challenge you do. It's just maybe not to the same degree. And of course, with forgive me if I misstate it, but I know that, I don't know whether it's 10 years ago now or so, there was a major re-regulation approach. And that I think also hurt the numbers in Australia a little bit. But we have a demographic challenge here. So that's part of the problem that we're experiencing. There's been a very significant increase in schools offering financial planning as part of an undergraduate degree, where students come out now able to sit for the CFP exam immediately. And that training and education has been extremely valuable. It's still not where it needs to be. And there's still a big perception of wealth management and finance sort of all looking at like one thing, especially between men and women. Not enough women are coming into the profession, especially here. So that said, to answer the other part of your question, there are some programs that, and many more that are coming online, that are emphasizing the non-technical skill sets, the client relationship management piece. Virginia Tech has a class, they call it CRM, not what we typically think, but it's client relationship management, where they go through the softer side. They talk about all the personal, emotional issues that come along with financial planning. And I believe that's becoming more and more prevalent, but surely I think it needs to become even more common.
One of the big trends that's, I guess, shaped our industry over the last 5 to 10 years, in part due to that regulation, is this shift from financial advice being far more focused now on strategic advice rather than investment advice. Not to say it's not important, but it's a lot of our clients now lead with the strategy. It sounds like your firm is very much on that path, or very much leads with strategy. And yet on your website, again, you're also talking about your investment process, which is steeped in academia. I'd love to understand that broader offering a little bit more.
That's a really good point. So when I came into the business, financial planning was still evolving here in the United States. It was clearly being done, but there were not nearly the amount of opportunities as there are today. And more people were basically selling investments or selling insurance. There was no strategic planning of financial planning of any kind. Matter of fact, the way in a much more maybe layman's way that I describe it, is people got into finance to make money, not to help people. And today, I think that that's really shifted a lot. One of the things that attracted me out of the accounting profession and into financial planning was I already had this natural interest in sort of the investment world. I actually majored in finance, not accounting in college, went back for the accounting degree so I can make a living. But as I learned about financial planning and the idea that you could do this financial plan for somebody and solve this puzzle, and at the same time use those skills on investments or tax to help them figure out how they could get their kids to college or get themselves to retirement, or, help with a legacy or charitable goals. That, frankly, is what attracted me to the business. The idea of being a true advisor, not just a money person. And that was our firm is steeped in that, because that's kind of how we got started. And that's the mentality. We always say we're financial planners first, investment advisors second.
And on the investment side, how do you manage that?
Yep. So we work, just like you were saying earlier here with the systemization, we're very organized there. So we have models that we've built out. So we have, if you're investing in stocks, this is the allocation. If you're investing in bonds, this is the allocation. Of course, we factor in, the tax elements here in the States, how that works with those portfolios. And for implementation purposes, we use a pretty passive-like strategy, meaning that it's primarily around broad-based holdings all over the world, thousands and tens of thousands of stocks in your portfolio and bonds. We use mostly a dimensional funds type of approach to investing. And that's been a real plus for us, because it's really resulted not only in great returns, but it's a really good story. And frankly, not too often, with investing where you're in a position where you don't have to say, I'm sorry, because you've invested in something that went south. If you have the broad-based markets, everybody understands what their expected returns are going to look like.
So you mentioned you run models. So is that through an SMA or a TAMP style product, or are you still rebalancing at a client review?
Yeah, so we're modeling our own portfolios, and then we're rebalancing those portfolios ourselves through ETFs in the holdings that we have. So we're actually doing that trading. There are certain clients that, and just I'm not 100% sure how the systems work, regulatory wise here versus in Australia, but we do have some separately managed accounts that we use, but those are still geared towards indexes or broad-based portfolios. But we're using those portfolios for one of two reasons. Either A, the client has just big tax issues. They either sold a business or have some big gains. And we use that strategy to sort of harvest losses. Or the client comes to us with a portfolio of, let's say it's at least 20 or 30, but could be 100 stocks that have a lot of low basis and there's a lot of tax pain to transition out. So we'll use those separately managed accounts along with some cash to slowly transition the portfolio over time.
Imagine a world where wealth technology is simplified. NetWealth is continually investing in new tools and platform features to optimize your staff productivity and to give you and your clients the best user experience. With our managed accounts functionality, bring new efficiency and scale to your investment operations. A world of technology awaits. Discover it at netwealth.com.au/woo.
If we just change gears for a moment and sort of look more broadly at what's happening over in the US, not sort of politically or economically, that's a whole other discussion.
It is.
What are some of the trends in wealth management, financial planning that excite you or have perhaps even surprised you?
Well, I would say that there's two general themes that we could talk about. The first theme is within practices and how things are going and the use of technology. And frankly, even this convergence towards this comprehensive approach and how that is being impacted by the second trend we can talk about. And that is the private equity and the different investments that are going into firms. And frankly, the graying of the generation of advisors. The average advisor here, I don't know the exact data, but I would say the average advisor is probably close to 60 or late 50s, early 60s, and has not thought about a succession plan. So it's created a big opportunity for outside investors to be coming in. We could talk about either one of those themes.
I think all of those would be fascinating to our listeners. So back to you.
Okay. So, like I say earlier, a lot of people got into this business to make money. And even some of the ones that got into helping their clients when there are third-party companies, whether they're PE, family offices, or just strategic investors that are offering significant multiples to you to sell your practice or to take on an investor, it's really hard for some people, I think, to turn that down, especially if they weren't good at doing their own financial planning and kind of need that exit strategy, if you will. And what we've seen here in the States, and I think, forgive me if I'm wrong on this, I think you guys are pretty close behind us on this, right behind us, I should say, that the PE and all these investments are occurring over in Australia as well, is that you're seeing, I guess, two things. First is firms are selling to other firms that don't necessarily share the same investment philosophy, client-centric approach. I'm not saying that's the case in every instance, but it seems that that's occurring in some instances for sure, and more. And the other thing is you're seeing mega firms now come about, where there are firms with hundreds of billions of dollars under management, and the pressure to continuously have high growth and high margins such that firms that are invested every 5 to 10 years can, not that they're all like this, but the few that are, can recap and reinvest. There's a lot of pressure on the advisors to sell and to bring in more assets. And, I'm not saying I've seen this and I'm not saying it exists, but one would imagine there's this tendency to challenge your fiduciary views if there's such pressure from a board. And we are seeing some advisors that are caught up in that wanting to get out of those firms. I don't have any data on it, but anecdotally, I know of some instances where there's been people that have been like, enough for me at those places. So I'm wondering how that's going to happen. And, there's a theory here that some of these mega firms are going to start merging. You're seeing them advertising here, even on TV here in the States, and that they're basically going to be creating another big wirehouse or brokerage firm just from the other side, if you will.
It's a fascinating comment, and there is no doubt that that trend in Australia has accelerated in the last 2 years, maybe 3 years, but certainly in the last 2 years. And those observations are absolutely what's happening here. So it started off with a few firms merging. Now we're seeing mega firms emerging. Are you starting to see, obviously there's the consolidation of the industry. Are you starting to see the de-consolidation at all, where smaller firms or advisors are falling out of these big roll-ups?
Yeah, I don't have the data, but I do think, yes, man, I do think we're seeing that. I think we're seeing two things. We're seeing advisors that are falling out, actually three things. So advisors that are falling out of those kinds of firms. I see that people that are getting into the business now don't want to work in a big firm because they're afraid of, I'm going to go work for this firm. It's going to get bought. It's going to get bought again. It's going to get bought again. And they're trying to, be much more comfortable with being a solo advisor and starting their own business. So I think that's happening for sure. And then I think what's also happening is you have what we call wirehouses here, firms like Morgan Stanley, I'm not sure if the vernacular translates, but you're seeing more and more of these advisors that historically have stayed in the big wirehouses like a Morgan Stanley or a Merrill Lynch. You're seeing those people now leave to start their own, what we call here an RIA, because they think, okay, we'll leave with this AM, we'll work for a couple of years, 4 or 5 years, get it off the ground, and then we'll sell to PE, and we're going to make a lot more money than if we stayed here in this wirehouse. So there are way more firms starting than there are disappearing.
And then if you extrapolate that out a little bit, you've mentioned before that you've got an aging advisor population, so average age of 60. That feels like a great way to solve for that problem, in that you're able to sell into these PE roll-ups. What are some of the other options that you're seeing overseas?
Yeah, so not a lot of other options I want to emphasize, but what we're doing at our firm, because this is what, I believe is great and what our firm believes is great, is I'm a big fan of just trying to keep it employee owned. Now that's a hard thing to do, because if the founder waits too long, the firm becomes too valuable for the next gen to buy in, and they are not entrepreneurs. They did not quit their job while their wife was pregnant with their first kid like I did. They came to work in a firm where they could get a good salary and good benefits. So, the founders need to do a couple of things to make that happen. They need to sell earlier and frequently. They need to sell or finance, in my opinion, because they can give better terms. And they need to support the employees with good education and understanding and leadership, so that they feel confident that they can move into leadership, that they understand the entrepreneurship, they understand the financials of the business, and that they feel confident that even if they have to take a big loan, that it's going to be a smart thing for them to do over time. So you really have to be willing to educate them not only on how to be a great advisor, but how to be a great owner of a business.
So would most of your staff have some ownership of your business, or does that come into play when they move up into, say, a senior advisor role?
Yeah, we have half of the employees own some ownership in the business right now, which is not common at all. I started selling shares in the company right around the time I turned 50 and felt like that was a good time. And every 3 years since then, I've kind of sold a tranche of the shares to the employees. So I still own about a third of the firm, but the other third is owned by the employees, and there's a continued expectation. As we move forward, that is a primary focus for me. I have no intention of retiring. I always tease the team that as long as I do something that makes them think I'm valuable, they'll hold on to me. But I have no intention of retiring, but I do believe that I should get rid of a lot of my equity and get out of the way. And I'm a little resistant to let go all of it because I think it's a great investment, but I don't want it to be a barrier to their success or their belief that they're going to be in control. So one of the big things we've been working on is trying to figure out how to expand our ownership base. And we've been talking to some other firms, not many that exist, but that have the same viewpoint, in trying to see if we could join forces with the mindset of creating even larger shareholder base, reduce the owner's equity by watering it down by just a function of the merger, to give the team that confidence.
I know there'll be quite a few listeners that'll be interested in the actual mechanics of how you do that. So have you got a formula that allows you to price the shares each year? Is it performance-based? Is it a free-for-all and anyone can buy shares? How do you actually manage that sell down, if you like, each year?
Yeah, so there's a couple of different ways to do this. I've always been the most comfortable, just my nature, I guess, to go out and hire a third party to value the firm, because I did not want to be having my hand on the button on that. I thought it was unfair to the team. So, matter of fact, I actually give them the report that the firm creates for the valuation of the firm. And what I tell the person valuing the firm is, I'm not looking to get maximum dollars here. I know that I can sell it greater outside, but based on reasonable multiples on a trailing 12-month profit, not a go forward, how most deals are done, and an actual P&L, what's a reasonable multiple, what's our EBITDA, and what's a good valuation. And then I give them the full report to the team. And then what we've done initially was, at first, I primarily focused on the advisors and the senior people on the operations team to buy shares. Now we've really tried to disseminate. My feeling is that anybody who works in the company should be able to buy stock. The challenge is some people it might not fit within their financial abilities. So we're working on a program now where we take a certain percentage of the profits each year and sort of allocate that to buy shares and put it aside, if you will. It's kind of like a synthetic or phantom type equity, but that these people could get equity as well.
And one of the challenges with equity when it does sort of sit across such a big shareholder base is clearly liquidity. Is there a mechanism for staff to also sell their shares at that same time of year?
Yes. So far, nobody's wanted to sell their stock. Fortunately, it's been a very good investment over time, so that hasn't come about. But there seems to be a pretty strong appetite. Anytime anybody has wanted to sell shares, there's always been buyers. I would imagine that I would take back shares if somebody really wanted to and there weren't enough buyers. But I think this gets back to my other point here. At a 23-person firm, it's kind of hard to have a good exchange, if you will. But if we can join forces and get a deeper bench and increase the amount of not only capital in the firm, but people in the firm willing, I think you could really build out a program where there's a constant exchange.
So one of the things you've mentioned a couple of times now is this potential to merge with other firms. Is that to drive continued growth and scale because you need to remain competitive and sort of be able to do that? Or is it about that shareholder base? Or what are the motivations behind, potentially merging with a firm? And maybe second question to that is, outside of that, what are your real growth strategies? How do you make sure that you're continuing to grow the business at, call it 15, 20% every year?
Yeah, absolutely. So I would say there's probably 3 reasons that we would look for some sort of partnership or merger type of opportunity. Yes, one is what we just discussed. I think it makes it a lot more palatable to the shareholders to have that deeper bench and a lot greater success probability. The second reason is because I've always just loved the business of the business. And while it's been 29 years, shockingly to me, that I've been doing this, I've always wanted to do more. And the idea of offering more services to clients than we do now, it's kind of hard to do some of those things when you're a small firm. And the idea that we would be bigger would allow us to potentially make bigger investments in either offering services or hiring, in a small firm. Again, you have a lot of people wearing a lot of hats, right? So to hire some dedicated staff for different things, whether it's marketing or other areas of the business. So I would say that's number 2, because I have these things I want to do, and I feel like our size is holding us back a little bit. The third thing I would say is M&A itself. So I've had the fortunate experience of having 3 transactions that we've done, all very small, like $100 million books of business, where there's been an advisor that I know who's looking to retire in a couple of years. They join our firm, we pay them out, they retire in a couple of years, and we've bought their practices. And that's been just a fantastic way to grow the firm, and that's been a great experience. So the idea that we would have a firm that's employee-owned with the intention of staying employee-owned, that's bigger, to me sounds like we would have a better track of attracting, although it's a smaller population, the population of advisors that want to stay employee, we have a good chance of attracting those folks.
On the concept of loving the business of the business, clearly great culture, you've got fantastic employees and a number of ways to reward and recognise them. Maybe a bit of a pivot into branding. Wealthstream, great brand. How much do you invest into that? And is it an important part of your growth to actually, I guess, grow the brand and perhaps not Michael Goodman?
Yeah, good question. So I'll start off with saying, the brand is important to me personally. I like the name that we came up with all those years ago. As I would imagine any founder who's worked in their company for a long time, it's a bit of a personal attachment to me. That said, because we're in New York City, to be perfectly frank, our brand's not that valuable. There's a lot of brands that are much more well-known. And if you asked anybody off the street, they would never have heard of Wealthstream. Where I think the brand is valuable and what really matters is the relationships that we have with our clients and also with our COIs or centers of influence, the attorneys, the accountants, and within the industry, the way that we are perceived in the industry. And that really is what matters most. And those are the things that we invest our time and energy into. If I was in a smaller town where I could make an impact in the community with our brand, I would be interested in doing so. But there's really not a lot of point in spending our money to try to do that in New York City.
Okay, so you're not investing necessarily into a big digital campaign or sort of above the line advertising. It still really is around word of mouth and that referral source.
Yeah, well, that said, we have done some work. I guess you could say we have made an investment. I just wouldn't call it very substantial. But we have made an investment in a digital marketing program around one of our niches, which is working with people with public company stock, actually a private as well, but it's just more common public. So, and we've tried that, whether it's been LinkedIn advertising or otherwise, and it's been okay. But in that, we're not brand forward in our advertising. I guess you really can't even call it advertising. It's really more communication, but we're not brand forward in that. Our brand is in it, don't get me wrong, but what we're really showing and we're really trying to push forward is expertise. So an example might be we have a email education course that you can sign up for to learn about how you work your stock options or something like that. And of course, it's got our brand in it, but we're really investing more in education.
Yeah, makes sense. Michael, we're running out of time, but it would be amiss not to ask you how you're using AI in your firm.
Yeah, I would say that I feel like there's a lot more that we could be doing in AI other than what we're doing now, which is primarily using AI note takers, which is pretty common these days. So I don't think we're cutting edge by any stretch. The AI note takers are really helpful in summarizing meetings and helping the advisors kind of save a lot of time there. The second thing is, of course, trying to be smart when there's work that we could do that we could offload to a large language model like ChatGPT or something like that. We're doing that. I think what we're doing mostly, which is not very satisfying to the listeners probably, is researching our options. We are working pretty hard on trying to understand and pressing the current vendors, whether it's for portfolio accounting, CRM, or otherwise, what tools that they're coming up with that we can use. But I think ultimately it's going to be controlling our data and learning how to use our own AI through the management of our own data, which is probably a goal for the next couple of years.
Is there a tool that you tend to use day to day in your own business?
So for me, at this point in time, probably is just communication. So I don't use a ton of technology that much. I'm probably, I live in either Outlook or through my mouth in meetings. In my role today, I'm mostly meeting with the team or communicating with them in one way or another. I wouldn't say that I have any kind of technology that I would boast about.
Fair enough. Michael, we are out of time, unfortunately. I know a couple of years ago you made the trek to Sydney for a dimensional conference. Any chance we're going to see you in Australia at some point in the future?
Oh, I would love that. I would love that for whether it's work or personal travel. I was there for not enough time. I had a wonderful experience. Every person I came into contact was so warm and friendly, and I can't wait to get back.
I look forward to you hopefully making the trip, and it'd be great to catch up. But more importantly, thank you for a fantastic chat.
Yep. Likewise. I really enjoyed it. Thank you, Matt.
Thanks for listening to this episode of Between Meetings. For more episodes and to subscribe to our series, visit the NetWealth website, iTunes, Spotify, or your favourite listening service. And if you want to contact me or engage or discuss any of the topics raised, please find me on LinkedIn or Twitter or send me a private message. We hope you can tune into the next episode.